Hello everybody. How are you? Nice meeting you. Greeting to our partnership, shareholder, my friend, new client and all the customer on the global. Welcome very much. I'm DR.Charles Kim, European Prestamo Group Company of CEO and Professor. Today, we can continue to inform to you the overview of the financing structure. Financing structure is already I told to you the operator financing program, on-ledger financing program. On-ledger financing program inside of the international financing program and local financing program. Local financing program is a direct financing program, indirect financing program. Direct financing program is the classification the short-term financial program, money market, and long-term financial program, capital market, and the foreign exchange program, foreign exchange market, and also the derivative market. That is the short-term financial market is the big science, and long-term financial market is same as big science. Foreign exchange market is normally speaking same as big science too. And the derivative market is much more as complicated and hybrid. The developing of hybrid commodity product type is too much derivative market too. Too big science. Indirect market is the banking, saving and loan market, and also fund market, insurance market, trust market. This is much more big science. Normally speaking, it will take time to completing of lecturing courseware for the like this one is it will take minimum 2 years. Normally speaking, is the university course is the 4 years, and also the other maybe which in grad school, in the grad school is the financing course is a separate one, because you know the which one do you want? Okay, no problem. But today is the our courseware is the introduced to you is the simple structure introduced to you, the fundamental financial concept. This is the financial concept of our lecturing courseware concept. But on the base of the applicant of the financial courseware is different one. You understand? Sometimes is the in term of international economic is the fluctuation is very fast and very much. You understand? Especially is the after COVID-19 is the Federal Reserve and the Euroclear Bank and also the almost the central bank, they can the unlimited quantitative easing. Now is a little the control after controlling of the COVID-19 and the pandemic situation. Each country is start to the quantitative tapering. You understand? But some country already is the tapering tantrum and also default of government. Sri Lanka now is the at the base of the difficult situation of the United Kingdom. United Kingdom is the problem over there, and also Italy and Spain. Turkey already is the defaulted, and also many countries now is the faced with the default, but we don't know how could they can make a solution. Because of that is everybody wanted to the understanding of the financing. You understand? Financing is the two mean. One is the money. You know, the money circulating, smoothly circulating. Another financing is the calculating. This is the money calculating. But the financing is maybe public financing and the private financing, the different one. But the arbitrage, capital, economic inside of what is meaning capital? Capital asset pricing model, the cash flow. cash flow matching. How to do cash flow matching is the maybe over there unit of the economic unit is the government and corporate enterprise and the personal is the how to do matching each other without trouble. This is very important one. That is the you think must first of all default. What is mean default? Insolvency, bankruptcy, insolvency, bankruptcy, insolvency. The default, how to default, government default, default declaration, and the consumer debt. Debt consolidation, A debt, B debt, C debt, there is over there too much kind of debt is consolidation. How to do consolidation? Debt settlement, credit counseling, bankruptcy, debt diet. Big debt is how to do diet, everyday diet to do. There's the many know-how, you understand? And that snowball method. That snowball method is the two-way. One way is the dieting method and also the other snowballing method. Snowballing method is the every year is the bigger than. This is the snowballing. Snowballing is two meaning. One is dieting and increasing. That of developed country. Developed countries they are almost is very very heavy debt. How to do dieting? This is the politician and the economic maybe the planner department and the secretary they should do it. Asset type there is many kind of asset, but the normal speaking is real estate, the security, commodity, futures, cash, and the discount cash flow. How to discount cash flow? Discount cash flow is the like in the future 10 years. Futures in the future 10 years maybe the discount cash flow how to calculate. This is a calculator formula over there. And the financial capital, funding, entrepreneurship, you know, entrepreneurship, professional businessmanship, entrepreneurship, fixed income analysis. You know, floating analysis, fixed income, floating income. Fixed income is like this. Every month is the principal rate interest payback. You know, this is the maybe the fixed interest. Maybe is you can buy up the USA Treasury bill, Treasury bond, Treasury maybe Treasury bill, not bond, and Treasury inflation. Treasury inflation protect security like this. This is the fixed income. Every year how much you pay. But the floating income is different one. Maybe your business, personal, small restaurant business. Maybe summer season is very good in the beach side of restaurant. But in the city, the winter season is a 5-star hotel of the buffet is very nice. Christmas season, because of the different area, different of the income analysis. And the gap financing, you know, gap financing is this is another small technology and know-how how to do financing of the gap financing. Global financial system. Global financial system is the local financial system and the global financial system. Similar the same, but a little different one. Hedge. Hedge is is escape from the risk. Simple one. Is how could you escape from the your investment is from the risk. This is a hedge. Hedge is the hedge fund. You know the hedge fund manager. Basis risk, and the interest rate, risk free interest rate. The coupon maybe just if I said to you the risk-free interest rate. Maybe you can buy up the treasury bill in USA like this European bond, Euro bond. This is the big bank, especially the keynote bank, key currency, the global key currency. This is the normally speaking the risk-free interest rate. But some small country of the government bond, there is maybe the little possibility to maybe default. You know, default, IMF default like this one. But normally speaking is not any problem. This is the normally speaking the big country of the government bond. This is risk-free interest rate, coupon rate, how much? And the term structure of interest rate and short-term model, Bessicek model, Cox-Ingersoll Ross model, Hull-White model, Chen model, Black-Derman-Toy model. This is the maybe if you enroll in our curriculum courseware, we can give you the maybe the graph, understand, graph and also the formula, function formula, and explain to you. Interest, effective interest rate and nominal interest. And the interest rate basis, Fisher equation, the crowding out, annual percentage rate, interest rate, and the interest coverage ratio. This is the interest rate is the small science, no problem, but we can explain to you very clearly. Investment, foreign direct investment. This is the FDI, what you call foreign direct investment. But the other 95% of our client and the customer, they cannot clearly distinguish with the foreign direct investment and the foreign direct the non-recourse loan, limited recourse loan, recourse loan. Loan and the investor is different, you understand? But the investor and the loan, you understand? But normally speaking, the foreign direct investor is like this, cannot joint venture with you. But in term and the condition, maybe if they can make big money of a project over there, there is the other one project which is the other can make big money. In this case, we can negotiable of the foreign direct investment program. But the other, normally speaking, they have a project. There is many kind of project, maybe 300 kind, 500 kind, maybe 20,000 kind of project. They are your country. But many people contact to us, visit to our office in Brussels and Hong Kong, Frankfurt, London over there. They only, okay, you invest here and give me the 51%. It's impossible, you understand? Direct investment, you understand? Direct investment is if there is a good project, okay, we can direct investment. No need you understand? Why we can give you the 51%? That is impossible. You understand? Because of that, the government is they want to develop a project. The competitor means to directly contact to us, no problem. You understand? We can make a solution. Big, huge amount of money is with direct foreign direct investment program and put into your project, no problem. The nuclear power plant and maybe clean energy project, highway, refinery, and also the car assembly project, heavy equipment project, airplane assembling project, heavy engine, maybe 5,000 ton to the maybe 400,000 metric ton of the engine, like this kind of the diesel engine and the atomic power engine developer, no problem. And the airplane is engine, you understand, like this developer. And also another maybe quantum computer development program over there. Too much program, okay. In this case, we can continue to communication and negotiating with mutual beneficial base. You understand? Equalization and reciprocity and the mutual beneficial base. We can the mobilize of the big amount of foreign direct investment program. You understand? No problem. But the direct direct financial market, indirect financial market. First of all, you need to understand of yourself very, very well. You understand? And the gold as investor, gold as an investment. You understand? Gold investment, bullion investment over there. Maybe in London, we can maybe the 50 ton of the gold bullion deposit in the LME over there. We can liquidating, you understand, liquidating, and maybe issue of the SKR, you understand, safekeeping receipt. And then this safekeeping receipt is the other, it's bank instrument. We can financing, you understand, financing, and maybe the monetizing, and also put into the private placement program, you understand, and the one years maybe 300%, 400%. And then this is put into the infrastructure project and the humanitarian project. You understand? There is the many way solution. Otherwise, is the maybe we can maybe the government give us a special policy. Okay, we can raise up funding, set up a fund of your project. We can make a solution in the maybe the New York financial market and London financial market, Dubai financial market. There is too much of money. You understand? First of all, is the key is you give us the good project from the competent minister of your government authority, and also maybe is you have a very big project of the private project, personal project, not any problem. You understand? Contact to us with open mind. You understand? With open mind. But the other small intermediary is sent to the email and also 50% how much we cannot negotiable. You understand? Over investing, leverage. You know the leverage, how to do leverage. This is the technology. Maybe M&A. You understand? M&A, like this. Maybe the company. Maybe the other share up. You understand? Carving out. Like this one. How to do leverage. The leverage buy out. How to do. This is the other. Maybe if you want to be of the financial specialist, you can maybe enroll in our curriculum courseware, lecturing curriculum courseware. You understand? How to do leverage. Leverage is many ways. Project financing leverage and also the M&A leverage, quite different. Understand? The loan, financing loan. Loan is the like this. Short and long. Short is the sell. Maybe this is sell. Sell and waiting with price down, buying again and return, payback, return to them. And the long is like this. First of all, buying and also price increase of stock. Maybe now is buying up the $100, $100 per stock. You understand? Per share. And then is maybe price is going up. You understand? Going up. In this case, sell out maybe 150. We can make 50. And 100 return, like this one, and the liquidity, you know, the liquidity crunch, understand? Liquidity is meaning that the cash, you understand? Cash, securitization, and securitization is meaning that the liquidity, margin, margin is, you know, the other like this, A and B, like this, we buy up this is the $1, and also we can sell out of the $1.2 per piece, and 1 million pieces we sell out. In this case, margin is 20% margin. This is the what kind of margin? Is the gross margin. Net margin is the maybe deduct of cost. Market to market, market impact, medium of exchange, medium exchange. How to do this is the maybe medium exchange. This and also the maybe another this is exchange. How to do exchange is medium, media. Medium is the money, cash. This is medium. Microcredit, money creation, currency, coin, banknote, bank bond, bank bill, counterfeit, history of money. Monetary reform, portfolio. You know, portfolio is the other. You understand of portfolio and the modern portfolio theory, mutual fund separation theorem, postmodern portfolio theory, reference rate, reset, is a return, absolutely return. Return and yield, there is the return and yield. You know, the yield, return is the contract over there. You know, the maturity data is the liquidate. You know, the liquidate cash. Maybe you can buy a government bond, maybe 500 million in US dollar of the treasury note. Treasury note term is 10 years. Now, this is the other 3.5% interest rate, coupon rate. In this case, 3.5% is the every years. Is the payback from the government to you. This is the yield. You know, yield every year's yield. Return is the Okay, 10 years, maybe every year, for example, 3.5%, 10 years is 35%. You understand? 35%. And maybe you buy up the 500 million, total maybe 700 million you can make. This is the total return. Yield is the average 3.5% is the average. This is the yield. You understand? Yield curve, return, and yield curve you need to understand. The set return, absolute return, investment performance, and the relative return. Return is the different one. Return is the absolute return. Absolute return is the maybe maturity data. The 5 million return. But now you buy up the CD, CD only 1 billion face value CD is bought buy up the 900 million. In this case, after 1 year, you understand, is maybe this commercial bank give you the 1 billion. This is the absolute return. Relative return is a little different. You understand? Relative return is the maybe there's the term and some term and the condition over there. You understand? Condition, maybe this condition we can give you the, although face value is the 1 billion, but the other in this case, in this term and the condition, okay, 950 million. In this case, 970 million. This is the relative return. Relative return. Risk, financial risk, risk management. How to do risk management? There is the many kind of the risk management. The financial risk management, uncompensated risk, risk measure, the coherent risk measure, deviation risk measure, distortion risk measure, spectral risk measure, is the value at the risk, expected snowfall is snowfall, anthropic value at the risk, scenario analysis, short is just for short and long. Is the short is the borrow and maybe stock is the borrow and sell out and waiting to the stock is going, stock price going down. Maybe now is I'm borrow 5 million stock from you or your stock company, a stock company is a secret company, and how much per stock is the $100 US, and also now is the world macroeconomic in the world of the stock market is creeping down, going down. In this case, waiting 3 months, maybe 5 months. Okay, after 5 months. Okay, after 100 now is the borrows, the face value is 100, but the after 5 months is the 70. In this case, I can buy again and also return to the same quantity of stock and also some fee and charge interest. This is the short, the speculation. Speculation, you know very well. Investment and the speculation. You need to understand. Day trading. Position trader. Day trading is the fast trading. Today is sell and buying like this day trading, everyday trading. Position trader. Trader, if you are a seller and the brokerage and maybe stock trader, you are very fast the quantitative stock trader through your computer window. You understand? Today is this market how much, that market how much, maybe New York SE how much, S&P 500 how much, Nasdaq 200 how much, you understand? Tokyo how much, Korea how much, Hong Kong how much, Hong Kong Hang Seng maybe is the stock how much, and the H stock market how much. Like this is the position trader. Position is today is the position this one, tomorrow is the position that one. The position is meaning that the very wide sense. You understand? Very wide sense. Spread trader. Standard of deferred payment and store value, time horizon. You know, time horizon, time vertical, time value of money. Time value of money you need to understand is the 1 year's time of the money value how much, 2 years money value how much. This is time value of money is the interest rate. You understand? Exactly speaking, interest rate. and the discounting. Discounting like this, maybe if you commercial banker sell to the certificate of deposit, CD, okay, CD is the, now is the 1 year's CD. You understand? For example, CD is the normally speaking short-term financial market of the trading way, CD, okay. In this case, now the maybe the interest rate in the market interest, the average market is how much? 3%. In this case, CD face value is the $1 billion US dollar, but they can discount of the CD is the 970 million sell to you after 1 year. In the maturity date you come here, we can 1 billion to you, but over there 30 million is the interest rate. 30 million interest rate will deduct of the income tax, and the futures value is the present value and the futures value. You know, futures value now is the 1 billion. Futures, 1 year's futures is the other, maybe normally is the time value of money is 3%. You understand? 3%. Okay, in this case 3%. But the other interest rate is calculated is different one, different one. And the net present value and the net present value, you know, and there is the many calculate way, as a formula over there is the maybe now you have 1 million, but they are after 30 years. In 30 years, how much net futures value how much you can calculate, that there is the formulator, you understand? Formula over there, and the internal rate of return, internal rate of external rate of return, modify of internal rate of return, annuity, perpetuity. Perpetuity is the other like this. This is hybrid bond, hybrid security like this. Now bank, you understand? Maybe JP Morgan like this. Okay, you can 5 million deposit here. We can perpetual issue. We can sell a perpetual bond. This bond is in your life. We can continue to pay for the interest rate. Maybe if you die, you know, pass away from the global. In this case, okay, no problem. We can return to the principal. There is the many kind, but the perpetual is the now is very popular, and also the other as the issue of the hybrid bond, hybrid security. Trader, free trader, free market, bear trader, unit of account, volatility, yield curve. You know, trader is the other commodity trader, money trader. You understand? And also the product, many kind of the commodity trader, many kind of money trader. You understand? Interest trader, stock trader, bond trader, too much kind of trader. You understand? But yeah, you study of yourself. Volatility. Volatility is a very simple one. If you maybe open a window of the stock market window, you can check up the volatility. Volatility is the other. Every day is the other. Every second, real time is the other. Fluctuation. You understand? Fluctuation of the price. The financial history. The finance history, banking history, insurance history, and also the maybe trust the history of trust, history of insurance, history of bank, history of financing, financing market. There is a big history, because this history is the like this Weimar Republic, Wall Street crash. This is maybe great session. The 1929, and the Great Depression, 1930s, and the Bretton Woods Accord. Bretton Woods Accord is 1944. 1973 is oil crisis. You know very well, And the saving and the loan crisis, 1980. Black Monday, 1987, and the Asian financial crisis, 1989 start, end of 1989. But the other 1990 is the very seriously, very critically in the Asian market from the Thailand and the Korea is the shocked by this one. Dot-com bubble is the 1995 to 2000 1 years. Stock market downturn. Stock market downturn is 2002 years. United housing bubble, financial crisis is 2007 years to 2008 years, followed by the Great Recession, subprime mortgage. Everybody know very well, like this one. The financial term by the field, this financial term by the field, you need to understand a little, okay? Is auditing, account software, bookkeeping, is bookkeeping, double bookkeeping, is the maybe company double bookkeeping. And the United of CPA system of test system, FASB, financial accountancy, financial statement. Financial statement, you know, the 5 kind of financial statement, balance sheet, and profit and loss statement, income statement, and the cash flow statement, etc. And also management accounting, philosophy of accounting, working capital. The working capital, everybody know very well, is the hedge accounting, IFRS 9, fair value accounting, banking, how to do banking. Banking is the corporate financing, maybe corporate financing theory and the financial management, how to do. Banking is the, normally speaking, saving and loan market. This is banking. Saving and loan is banking. Balance sheet analysis, financial ratio. Here, balance sheet is normally government, central bank analysis, balance sheet. Government, treasury, department balance sheet. And this is the maybe economic unit of the government. Central bank balance sheet, commercial balance sheet. And also maybe company balance sheet. And the security company balance sheet. And maybe manufacturing balance sheet, and the personal balance sheet, a little different one. Maybe some is the other bookkeeping, normal single bookkeeping, but the big manufacturing is the banking, and also like this is double booking. And the financial ratio, business plan, capital budgeting, investment policy, and business valuation. Valuation, how to do valuation? Evaluation. Valuation is different one, and the stock valuation, fundamental analysis. Everything is needed to the before investor is a fundamental analysis you need. The real option valuation topics, and the Fisher separation theorem, and the source of financing. Understand? Maybe Dr. Kim is your financing source from where? There is too much. Financing source where? You know, the bank and saving and loan, banking financing. You understand? Second is the fund. Fund is too much kind of fund. Big fund, you understand? Especially, and also fund is too much kind of fund. Maybe is the next time I can lecturing course where fund. Fund is from the which fund? How to do is the setup fund and also the raising of a fund. This is needed to the long lecturing course on behalf of you and your client. No problem. Valuation topics, Fisher separation theorem, source of financing, security, that initial public offer. Yes, public offer is the initial public offer. Private placement and public offer. Public offer is the offer, you understand? Is the gathering offer from the many people. But the USA and maybe European Union and the Asian financial market is the public offer is the similar one, but the private placement different one. You understand? Private placement is different one. Because you know, maybe if you issue up the standby LC to me 500 million, and also we can maybe through the private placement gathering of 600% of the money and invest to your project. You understand? This is a different one. Capital structure. You know, capital structure. is the complicated through the maybe balance sheet. You understand? Cost of capital. Capital raising, how to do capital raising of the capital cost, the weighted average cost of capital. Modigliani-Miller theorem and Hamada's equation. Hamada's equation and the Modigliani-Miller theorem is different one. And the dividend policy, dividend tax, dividend yield, Modigliani-Miller theorem, the corporate action, strategic financial management, managerial financing, management accounting, merge and acquisition, leverage buyout, cash buyout, takeover, corporate radar, and also contingent value writer, real option. Inside of the cash buyout, and also in too much kind of how to do, the company is the separate, how to do separate, and the real option. Option is the like this, working capital management, working capital, current asset, current liability, reliability. Reliability is meaning that, but the accounting terminology of the liabilities, current asset and liabilities, and capital. You understand? It's very simple one, And the return on investor, return on capital, return on asset, return on equity. In here, total asset, equity asset, capital asset. Maybe capital inside of the equity and the liability. This is the capital. Asset is a liability, and the capital is equal to the capital is the liability and the equity equal to the asset. The loan covenant. Loan covenant is like this one. There is many kind of loan. Maybe some is the syndicate loan, maybe loan consortium. Syndicate loan and the consortium is the same, but the other UK financial market over there is over there talking about the consortium loan. But if USA, New York over there come there is this is a syndicate loan. But Asian is normally speaking, they say syndicate loan for the project financing program. But the other corporate financing program and the structured financing program can provide up the syndicate loan, not any problem. You understand? But the other, normally speaking, in this case, the corporate financing program and the structured financing program inside, they don't want to do the syndicate loan. They can directly in their cost, and also they can do it. This is a different one. Cash conversion cycle. Cash management, strategic financial management and the cash management. The financial management and the cash management is quite different one. Inventory optimization. This is manufacturing side. And also supply chain management. Just in time, economic order quantity, economic production quantity. This is economic order quantity is EOQ. Economic production quantity is EPQ. And the economic batch quantity, credit, creditor, debtor, and creditor, different one. Credit scoring. Maybe if you are credit scoring, is how much the scoring point, okay, you can get over the how much like this. Default risk, insolvency, and also maybe bankrupt risk. Bankrupt risk. In here, first of all, default risk and bankrupt, and maybe workout and insolvency, declaration of insolvency. The discount and allowance. Discount and allowance is different. Discount allowance is the give you the scope of the percentage, how much percent allowance give you, and maybe if you I give you the maybe 80%. Okay, you can only 10% discount and also another 10% allowance is returned to your profit. This is allowance. So factoring rate and supply chain financing. And management investment. This is a portfolio theory. Active management. the efficiency market hypothesis portfolio, modern portfolio theory, capital asset pricing model, arbitrage pricing theory, passive management, index fund. Fund is this index fund is belong to the derivative index fund, and activist shareholder mutual fund. The open-end fund, closed-end fund, maybe this is a European fund. European fund is a closed-end fund almost, but open-end fund in the USA market. But this open-end fund is the low problem. Now is the closed-end fund and open-end fund. Closed-end fund is very conservative way. You understand? Maybe if you invest over the 10 years project, you cannot call off of this fund and cannot return whenever you demand for the big amount of money. This is very big problem. In this case, is the closed-end fund and open-end fund. Open-end fund, every time you want to return the money, but closed-end fund is like this. This is the closed fund. Is this fund you invest the money? This is the closed, cannot return out, cannot cancel. But this fund program, commodity is the within 3 months register of the market, fund market over there, is open market over there, sell and buying, no problem. You understand? Maybe you can put into the 500 million. This fund you buy up the fund product, and then is the after 6 months you really demand for the 500 million. In this case, you can sell out. You understand? Sell out. But the other some negotiating of the market interest rate is the market interest rate. In terms of market interest, is they can discounting how much of this fund like this one. You know the term and the condition. Sometimes is this fund is the coupon fund. You know the otherwise is a discount fund. The different one. You understand? Different one, different sale. And the list of mutual fund family. You know, mutual fund is you need to understand what is the meaning that the mutual fund and the financial engineering, long-term capital management, short-term, mid-term capital management, short-term financial. Maybe the hedge fund is the short-term financial management, capital management, and the hedge, quantitative investing, the personal financing. Now, able account and asset allocation, budget, Codwell education saving account, credit and debt, education IRAS, and credit card, you know very well credit card, and debt consolidation, mortgage loan, you know the pledge loan, mortgage loan, maybe real estate like this, the fixed asset, and the current asset, you know current asset and fixed asset different. But here, maybe the mortgage loan, the continuous repayment mortgage. You understand? Payback mortgage. You maybe buy up in New York City inside of Manhattan over there is the 500 million of apartment you buy. But the other, maybe leverage the LTV, loan to value 70%. Okay, in this case, the government bank is give you the several formula. Is the fixed rate, floating rate, and also the how to do continue to repayment is a principal at the interest how much. Maybe there's a 3 or 5 more formula give you, and also you can option, and then is the you can option this one is in terms of this one you can continuous payment of the mortgage, your mortgage, maybe 30 years. Maybe now is you are working very good area is the other you can give me the prime. You know the prime, and maybe prime, and there is this 3 kind of the grade give you, credit give you, and also another they have the point of the too much complicated. This next time is the subprime mortgage. The lecturing course I can continue to the lecturing to you. Debt card, the credit card and debt card is different one, and the direct deposit, employment contract, and the commission. Employee stock option, you know, stock option is a company stock option. Employee of the fringe and benefit. The stock option is the you are a very high good. You have a very good management, and you are a very strong of the sales network as the sales manager, sales director. In this case, is the government. No, government is the company give you the stock option. Maybe you are working here 5 years, you understand? Term and the condition over there is we can 1 million of stock give you, but the not now is not now. Is it every year how much? In terms of your sales amount, you understand? Sales amount and the return profit, how much? We can give you the how much like this. And also you are working very hard here through the night, you understand? And also you can sales amount like this one, 5 years. Okay, we can give you the stock. And this stock is you cannot sell out now, you understand? But you can step by step sell out maybe maybe within 10 years, within 5 years, like this one of the binding of you cannot run away another company. This case is the stock option, employee stock option, and the employee or fringe benefit and health insurance. You know the health insurance everybody know, and the paycheck, salary, wage, financial literature, and insurance, predatory lending, retirement plan, Australia, USA, Canada, retirement plan is different one. As United Kingdom, United States is 401A, 401K, 403B, 457 plan is a core plan. Individual retirement account, Roth IRA, traditional IRA, SEP IRA, simple IRA, pension. This is a big science too. Simple living, social security, tax advantage, wealth, comparison of accounting software, personal financial management, investment club, collective investment scam. This is the personal financing. Next time, continue to lecturing to the next time is the public financing and company financing, corporate financing. Continue to do. Thank you. See you again in 30 minutes. Thank you very much.